So I'm going to present today a bit on the hydrogen project investments and the risk handling involved with them. And I'm going to do the obligatory start of presenting a bit CRATOS, present the hydrogen investment environment, then go into the methodology and the project risk management and looking at some main risks examples, and then overall project investability and a few key takeaways at the end. So without further ado, CRATOS has a vision is to become a major player in the green hydrogen market in Germany and other democratic countries. I'm joining from Canada, but our headquarters are in Hanover, enabling a fair, secure, and just energy transition. And to give it a short overview, we do services and investment. On the services side, we do anything from project management and development, engineering and modeling, financial services, consortium management, and with that, we try to navigate the complexity of the sustainability puzzle with hydrogen as a central focal point. That being said, we remain technology agnostic, meaning that we see hydrogen as a solution, not necessarily the solution, especially pre-feasibility phase. On the investment side of things, we take an approach where we both de-risk the project and invest ourselves with some co-investors. And that's why we think we are the key investment partner for many of the potential investors wanting to invest in hydrogen. I want to talk today a bit about some of the potential issues that might appear, some things to look out for. So hopefully that will lead to some good discussions. As I mentioned, our goal via investments is to de-risk at the same time as providing that value. So we are trying to enable that that risk to be lower from the beginning on with having the right project at the right time at the right location, and throughout the development to de-risk via services that accompany the investments. So hydrogen investment. A lot of hype, obviously. I'm sure a lot of the people in the call have thought about hydrogen or at least heard of it. It's got some key advantages in terms of that it's clean. Today, the low carbon portion is quite low, but the potential is there with about up to maybe 98% of the hydrogen in 2050 being low carbon. It has also a very strong growth with the market potentially reaching up to 6.8 trillion US dollars by 2050. Values differ a bit. It depends what's the estimation of the energy mix hydrogen will cover, but the minimum is around 3%. We can see some estimates around 20% or more even. Generally 10% is probably a good median value. It's got a very high potential with reaching the net zero targets. There's some industries and sectors that cannot do without hydrogen. Today's there could be a good potential for export, with already by 2030, 20% of the hydrogen produced being dedicated for export. So very good for sharing that clean energy. Investment trends, we can see there's some strong regulatory incentives, a lot of capex and opex subsidies being announced, and also VC and capital markets are still excited, so it's still a good moment to jump in. I want to maybe point out a few hydrogen trends on the supply side. We've got some of the key subsidies like the 45V. We've got H2 Global for export and imports, the EU Green Auctions, and the Hydrogen Bank. Natural hydrogen, that means hydrogen extracted from the ground, has become a priority. That's quite recent. That's something you should probably keep in the back of your mind at least. We are seeing more realistic targets from developers. Costs are rising, both for renewables and electrolyzers and other equipment due to inflation. We can see that there will probably be an hourly correlation cost increased due to both Delegated Act 45V, We can see a few large projects reaching FID, like NEOM, uh, and factory expansions driving also potentially some of the issues that might be in the market in terms of lead time for electrolyzers currently being reduced for the future. On the demand side, we see a bit of a carve out of some sectors like residential heating and passenger vehicles, although the outlook for trucks has never been as good as today. Still, the strongest sectors and current sectors of green hydrogen are the main drivers for low carbon hydrogen. Um, and we see a rise of carbon contracts for differences, enabling a lot of projects to come strongly, also with some strong regulation from the EU side with AFIR, Fuel EU, and RED III, of course. So that's all good and nice, but most projects today are still announced, and a lot of these projects are not going to pull through to FID. So it's important to select the right projects. That's why we're here today. There's some funding and and delays, both on the public side and on the private side. And blue hydrogen has currently gotten better track record in reaching the targets, so that's also something to keep in mind. Um, when we see what we see today is basically these issues in terms of regulation, then delays and barriers, both on the regulatory side, but also on the funding side. There's some uncertainty with some funding processes taking a bit of a longer time. This new technology dilemma. Energy prices are still having an influence, especially in Europe, where electricity prices are relatively still high. And we also have that whole environment of uncertainty and complexity that's still an unresolved problem in some projects. So it's not a silver bullet. So you need the right projects and the right setup. Another few particularities, we've got this inherent complexity that I just talked about, complex value chain, many partners, any delays from one of the partners will cause some overlap. Some new technologies at these scales we're talking about nowadays. So some uncertainty there on the technical aspects. There's some supply chain issues with lead times for electrolyzers averaging above 16 months. Still on the technical expertise for installation, integration, maintenance, there's still a lot to be done. Safety and standards aspects need to be very carefully maintained. The environmental conditions, we still see a lack of infrastructure, long permitting processes, and some demand uncertainty in some sectors that I had mentioned. On the supply, contractual strategies are still working towards something a bit more standardized. We have lead times and also the feedstock issue with energy prices that I mentioned. I mentioned a lot of the funding, so I won't repeat myself, but there's a bit of a lack of appetite on the credit institutions side of things and cost of capital. Obviously, that affects all projects, not just hydrogen. On the offtake side, there's still some pricing uncertainty, both from the supply and then from the usage side that users are willing to pay. So it's important to have some risk sharing models. A few examples. So, for example, for Refine in Germany, there was some issues with integration and knowledge sharing between partners, and the pre-approval process led to delays and cost overrun. There was lack of adequate support for hydrogen valleys. 11 in Scotland had some issues, especially with COVID. All of that to say that it has to be carefully done, and even with large projects and large backers, it's not one shot for everything. So how we proceed? We take a relatively simple step to move forward with our projects. Oh, sorry. Basically going for project identification, information gathering and exchange, and we do a risk and financial assessment and move on to a proposal and investment decision. So that's something we are happy to take partners throughout that journey with us, with CRATOS skin in the game as well. and I will move on a bit into the risk side of things. So what we want to look at, we categorize risks into 4 categories: the macro side of things, the technical aspects, the management, and the economic aspects. Macro, I mentioned the infrastructure and public funding delays. On the technical side, we often see some overly optimistic efficiencies, potentially some issues with the maintenance and guarantees of equipment, the warranty periods, some lack of safety knowledge throughout. That's obviously a relatively dangerous gas, so it needs to be handled carefully, and also derivatives as well, if we talk about ammonia. There, on the management side, we see often projects moving forward with individual companies having their own project management, etc., but no consortium management as a whole, especially in some hubs. So that's something that has to be done, and something that should be key when you're looking at a project. On the economic side of things, the offtake contracts are sometimes built with unrealistic supply and demand. Business cases are sometimes estimating maximum public funding, which will be delayed, which will cause some working capital issues, and real data-driven modeling is still lacking. Often the costs are underestimated. So on the macro risks, you have to look at different aspects. So the regulatory drivers, like having carbon pricing, national hydrogen strategy is going to be very important. The renewable resource, hydropower is great. So if that's possible, perfect. High capacity factors, if you're looking at wind, potentially offshore, the overall cost and availability. Local demand is also key, with ammonia, refining, and steel probably being the huge off-takers here. On the transportation and storage, having that infrastructure or possibility to build that infrastructure is great. Country risk, obviously something taken into account with any project finance aspect, and energy insecurity actually is a positive driver for hydrogen projects. So countries like Germany, Japan, South Korea are looking to diversify their supply, are basically very attractive investments in terms of regions. On the technical risks, there's a relatively low upstream risk on the renewables. That's a fairly knowledgeable or fairly standard aspect of the project and the value chain. But all the other aspects of the value chain, especially if you're looking at the transport, the storage, and the integration of the different processing, balance of plant, and even on the end use, are going to be at least medium to high risk. So looking at the pre-integration work, securing your multiple offtakes and supply options, making the partners work together towards that less disparity of knowledge between the electrical side, the gas side, the operational side, is something that must not be underestimated. So it's important to look at the value chain, but there's not just the value chain. We strongly see the need for an ecosystem building and management. So if you see a project that hasn't built that ecosystem, it's probably not going to go to fruition, or or it will require the right support for that to happen. It's basically making all the stakeholders work together, having the cooperation platform. I mentioned already risk sharing. I'll mention it again. That has to be within the contracts. Also communication is extremely important. That's why the need for that consortium management leadership. On the economic side of things, I'll mention maybe just the difficulty sometimes to getting some credit from private institutions. Often the models that are a bit uncertain, they're waiting still for the market to develop. Hydrogen is a bit at where solar was in the early 2000s. So it makes things difficult. So looking at several aspects, for example, there was a survey of the main finances on the credit side, of what they see as the main factors hindering the potential of lending in such projects. Um, were, for example, the offtake risk, the lack of technology that are mature enough, and that is valid both for CCUS and green hydrogen, and the operational risk as well as the established markets. That being said, looking at the development phase of a project, it all starts with the siting on the concept and pre-feasibility phase, having the appropriate budget. We see often some budget squeeze that are very optimistic, which is nice, but doesn't play into reality once the work hits the fan. So having also the right strategy from the beginning, as well as during the feasibility phase, engaging early with the stakeholders, with the authorities, with the public, with not only the public but also the politicians, and having the right modeling and timeliness estimations. Exporting a lot of ammonia by 2025, if you start today, is not going to happen. So yeah. In the feed and detail engineering and FID, selecting the right partners, realistic design, a strategy to close funding with enough skin in the game from the sponsors is also key. On the construction side, you have to estimate the right lead times, both from the construction and integration, but also simply the supply chain. So get the orders in early. Don't estimate the commissioning and permitting process at the end. And on the operational side, safety and preventative maintenance, also key aspects to take into account. For seed investors, I think a lot of this is important to have as a basis, and most projects are probably going to be at the seed investment phase. So in the economics, what you want is the realistic modeling with databases that actually reflect the real price on the market. Quotes are probably not enough. You need quotes that have been fulfilled. Scenario-based and qualitative sensitivity analysis is extremely important. There's a lot of qualitative factors as well as quantitative factors that are heavily influenced by policy, regulatory aspects. You need funding partnerships, equipment and offtake guarantees, as well as warranties will be also key to secure the FID. On the management side of things, having the right communication, the right sponsors with experience, having that early engagement for the pre-approvals and communication platforms is also key. On the legal and regulatory side, you want a project that is already politically aligned with the policies in place, have the right regulatory analysis of that particular region, be it a state or a country, and what's coming up. Have a change and mitigation plan for those regulatory aspects, do some policy planning, some lobbying, get the early political support. For the timeliness, again, it's mostly about engaging early with all the different partners, all the stakeholders, and having that early design and planning that's realistic and as simple as possible. Project lead, I mentioned having the sponsors who have the right experience, probably one of the key aspects, and have the public support as well, backing that, backing the project in the form of subsidies. The renewable resource, that's going to be influencing the levelized cost of hydrogen for up to 70% or even more sometimes. Secure the PPA for at least 10 years, preferably do a PPA to offset that risk of also having the renewable assets within the project, and look at the full load hours as well. On the electrolyzer side of things, look for some electrolyzer OEMs with a lot of experience, having some electrolyzers already working and on the ground, preferably without any breakdowns, and having the right warranties and guarantees on the efficiency is also key. Public acceptance for the overarching projects, good ROI. Public subsidies such as ITCs should account for at least 20% pre-2025. And on the partner side of things, you need some documented support, some quotes to back the pricing estimates. And on the offtake side, I'd say you need something that's realistic with accounting for fluctuations of that demand and that supply. Last two slides. So what to look for, again, on the macro side of things, a bankable environment, basically, with enough subsidy schemes, potential lesser risk of policy change, having the authorities' knowledge and some relations, the location of the offtake and supply being relatively close. On tech and to back that up, you need the documented agreements, government and public support, letters of support. Already have some MOUs and LOIs in place, be it on the grid with the grid operator, or for the PPAs and offtake. On the technical side, stay simple. Look at realistic and reputable partners and OEMs. Always keep in mind that safety aspect throughout the development process, and on the design and logistics of that, make sure that the offers are in place. On the management side of things, the scoping for all the partners has to be clear. You need the management and sponsors of the project to have enough experience, enough skin in the game, both from the partners and from the lead sponsors. So perform your financial and the due diligence on the partners, and even going down to the consultants working on the project, and leverage that network of the partners. Because of those large consortiums, you can actually benefit from the different partners' network. On the economic side, remain realistic. The cost of electrolyzers you might find in literature. You could probably put a double price on that. Have the right contingencies in place, with the offtake and supply agreements prepared and secure, and do your financial analysis to make sure that is correct. We have our own modeling tool. That's always something we can help people with. Also challenge with the worst case scenario, assume the public funding delays. So in short, location. That will always be the basis of what's going to make a project more bankable than another. Planning and the design, as well as the project structuring and the ecosystem management throughout the project development and throughout the operations. That's going to be something that's going to be continuously needed, and that's going to be some of the key aspects for the project to both survive and be as profitable as possible. We can help identify the right projects, co-invest, and de-risk. So happy to talk to you. Those are my contact details. As mentioned by Julien earlier, we also at Hanover Messe. Feel free to talk to us, send an email, and yeah, that's it from my side. Happy to answer questions.
All right. Thank you for the excellent presentation, Tom. I think that you guys are hitting a very, very important nail here with consolidation in the hydrogen project. There is so much hype about it. There are so many technology companies, and everything is going to the roof and to the moon all the time. As you guys are actually doing the opposite, you're boots on the ground, you do co-finance, you are part of the engineering, you're part of the entire DD process and so on. So maybe for the investors that are here today, first off, do you offer consultation also based on, for example, investors that want to invest into a big hydrogen project, or do you just concentrate on the other side of the clientele?
No, we do both. So we sometimes provide our services for some partners and some projects that are in the development phase or in the operational phase. And we offer a financial analysis for and financial structuring for projects and investors so that both can come in together. And we offer a co-investment where we are an investor as CRATOS with other investors and come in as a fund together for an SPV that then invests in the particular project or in the consortium.
Perfect. Well, this is good to hear. So I have a million question. Krell has a million question. You have 3 minutes, so it's hard to select the best one out there. Maybe one out of it. You're talking about if we bring back to one of the slides, the earlier slide you had. So basically, all the projects and so on. And you said not all the projects will obviously come into fruition, and I think this is normal. It happens with every time we get new technology and so on. The main deciding factors for you, are they simply economically based? Are they simply regionally based? Obviously a mix of all that, I would say, but what is the most important criteria investors should be looking at when they're looking at a hydrogen project?
So at this moment, if you're looking for an investment tomorrow, the regulatory aspects and subsidy and political support is probably going to be the key aspect. That's driven by location. That was one of my last slide, location, location, location. That's one of the main drivers, but also having the necessary industries and supply are also driven extremely hugely by location. And if it's simple, if the offtake is right next to or multiple offtakes are right next to the production, easy world. That's why the most investments are today in hydrogen hubs, and it makes sense. There's a reason for that. So yeah, I think those are probably the two aspects that are going to be the main drivers.
Okay, and are there any example of project that you've been working with that you can divulge?
That we can what?
That you can discuss about, that you're not under NDA or under sealed, or that you can discuss?
Not really, not really.
Exactly. Okay.
Yeah. I would be it'd be my pleasure to chat with some of the members in a separate call, sign an NDA, and then we can share a bit more. What I can say is that we've seen a bit of everything on looking at projects. Some where very high hopes in the end from what we estimate in terms of risk and the financials, the ROI is not going to work out. Some we've underestimated features because there's some very good aspects, for example, deals with the grid operators that can enable a very low electricity price, which bumps up all the financial aspects very fast. Yeah, we've seen a bit all of it, and I think a
Perfect.
lot of sponsors are still trying to find that way forward. What is the right project they need to focus on? Because some have multiple, and they're
All right. I
all not
have
going
to
to work
cut
out.
you there, Tom.
Yeah,
I'm sorry, but the time is up, and Claudia is already joined here as a panelist. Thank you very much for that. Maybe in 1 second, is Europe at the level of US or US higher, or how do you compare them? 2
that's
seconds.
very interesting questions. Yes, I think Europe is actually higher.
Perfect.
Uh,
That's it. That's all we
okay,
needed. Thank
yeah,
you very much,
yeah.
Tom.
Okay.
All right.
Cheers.
Bye
All right,
bye.
bye, bye.